Dan, stocks had every reason to sell off and not rise into the close, and here we are. What do you make of it?
Yeah, it is pretty remarkable, especially after those two consecutive gains that we saw Monday and Tuesday after what was really a horrible close on Friday at a new 52-week low for the S&P 500. Look at where we are right now. We are 2% off this morning's lows, and we're doing this in the face of the 10-year U.S. Treasury yield up. The dollar is up. Crude oil is up. It just shows you, I guess, in this new month, turn the page and people want to buy after one of the worst months we've seen in many years.
The setup is interesting because it's not like we have no news coming up. We're in a vacuum of any kind. We've got jobs, we've got CPI, we've got earnings kicking off next week with the bank earnings on Friday, Dan. I mean, there's every reason to not be long this market, and yet, people are getting in. And so the question is, have we de-risked enough in terms of, factoring in that maybe earnings won't be so great? We've lowered the bar enough?
Yeah, I think that all that makes sense. I mean, the sentiment was so bad into the end of last month and the end of last quarter. Also, when you think about the fact that those catalysts that you just mentioned coming in a very short period of time, I mean, if that jobs number is a little cooler than expected, if next week's CPI number is a little cooler than expected, if we do get earnings that are decent enough, we talked about it on Fast Money last night, Mel, JP Morgan did what it kind of needed to do from a technical perspective. It filled in that gap from all the way back to November 2020 near 104. And when you think about that psychologically, that's really important. That was the date in which we got the vaccine news, right? So it round trip that entire move here. And so maybe the expectations are basically, in line with what the company is going to be able to put up. And on that next Friday, October 14th, we're going to have Wells Fargo, we're going to have Citi, some major components of the XLF. So could that be something that we rally into? Sure. But I think the big ones that we really got to keep an eye on are going to come in the next couple of weeks. And some of those are those major mega cap names where we know that the dollar is a huge issue. China demand, but also supply chains, European demand, all the above.
Yeah, all the tech names for sure. Let's get to what Jeremy Siegel had to say. The Wharton professor had some pretty strong words for the Fed on Squawk Box this morning, questioning if there is enough diversity of thought in the ranks.
The only thing we have to do now is kill inflation no matter what the cost. It disturbs me. There's not more dissenting voices at the Fed. That's what the Fed was designed to build with the bank presidents and the members. We're just not getting it.
It is interesting, Dan, that when you talk to various market watchers, there are differing opinions. Some people think that the Fed should pause. Some people think that the Fed has got to, kill inflation at all costs. And yet, when the Fed speakers come out, they are a united front in terms of where the Fed should go.
Yeah, so if the professor wants dissent, he should join finance Twitter because he'll have no shortage of that. And listen, those are all great points. But at the end of the day, I mean, listen, this is a Fed where there was plenty of dissent in and around whether the inflation was going to be sticky or transitory. We went through all of that in 2021. And I think it wasn't until we had a couple curveballs this year where they all kind of got in line. And whatever they are seeing, they're particularly worried about. And so, again, I wasn't around during stagflationary periods in the 70s and the early 80s, but it wasn't a great return environment. It wasn't a great time to be buying homes and the like, and the sorts of things that keep our economy going. So I get it. They really want to see some of these kind of stickier parts of inflation come in before they take their foot off the pedal. So for all those people that argue, yeah, they made a policy error last year and then they're going to make a policy error this year, and I don't know, maybe two negatives cancel each other out and they make a positive. I'm not playing for a soft landing right now, but I don't think the worst case scenarios are in the cards, even with the lack of dissent around what they're going to do about inflation right now.